Hello, it is Ed Butowski, and this is Wealth Transparency. What we try to do each week is find headline stories that don't get a lot of attention in the press and then explain what people should do with their portfolios as a result of this. I'm honored to have Michelle Connell with Portia Capital Management and Andrew Tang with Turner Financial Group here as my experts. And I want to start right off with, all the discussion has been about oil prices. But during this time, the bond market has started to cut rates, or rates have started to go down lower because people are buying our bonds. So tell me a little bit, Michelle, about the global bond yields dropping sharply and what that means for portfolios.
Well, when we have the lowering yields, that means that we've got concerned about growth, right? So I think there's a lot of underlying concern that things will slow down as transportation through the Strait of Hormuz slows down, or is it the minimum impeded? So that's why we're seeing the yields fall. And so maybe that won't be such a bad thing because we had initially priced one or two rate cuts at the beginning of the year. Then it felt like, well, maybe that's not going to happen because of oil prices, fueling inflation. Now it seems to be more of a growth concern overall, not only here in the United States, but globally.
Yeah, I often look at the inflation chart, and the United States is right in the middle of inflation. I mean, you have some like Venezuela, which is off the charts. Lower rates, is that not going to exacerbate inflation in a lot of these countries?
Are you asking me or are you asking
Yeah.
Andrew? It potentially could, but I think so many of the countries have higher inflation than us, as you said, especially when you look at like the EU and the UK and parts of Asia as well right now. So maybe they're willing to fuel the inflation if they have higher growth because we're blessed to have the amount of growth that we have here and other parts of the world don't. So that may be a larger problem for them as a lack of growth and they're willing to put up with higher prices for a while.
Andrew, I often say that the United States is the Pied Piper of the world economy. As the United States goes the rest of the world. So if the United States cuts interest rates, do you think that would increase the probability that the European Central Bank will decrease their interest rates?
It's no, I completely agree with you. I think U.S. is going to be the focal point of where capital is flowing for now and also into the near future. If we look at the second largest economy, they're still way too dependent on export. Their domestic economy is still in the shambles. They're still not out of the woods from the real estate bubble that burst in China. And then in Europe, the focus is really not on innovation. It's not there. And in my honest opinion, they are too entrenched into entitlement and regulations, and they regulate themselves out of innovation. That's my honest opinion. And the capital markets, it's not a robust one that we have compared to the United States. So when I see the commitments that are made from countries around the world to invest into the US and mainly revolving around the infrastructure or also buying planes, for the country with money, sure. US really, it seems like there's a neon light open for business and I see capital flowing from around the world coming to the U.S. And that's really going to be the case for the near term and also into the intermediate term.
Yeah,
Hmm.
I often wonder why countries buy US bonds. I mean, our rates are so low.
Hmm.
Um, and you have other countries that have higher credit ratings. I think the United States has a credit rating of about 9 or 10 in the world.
Yeah, it's really the intrinsic value of a country's currency. I've said this before is ability to collect taxes. So if a country has the growth and they will have a larger tax receipts, of course. If you look at the ability for other countries to collect taxes, it's horrible. It's horrible. Of course, European they have a higher rates, but to be honest, many individual corporations they have ways to go around it. If you compare to GFC's period for Greece, Spain, and Italy, it's just incredibly difficult to collect taxes. So the confidence of a country's fiscal and monetary system, it's also another amazing factor on the demand for the treasuries. for the company's sovereign debt. And so therefore, when you add those two together, you will see that US Treasury debt, it is still the number one sought after instrument in the world that is still considered risk-free. So in the formula of calculating risk, Treasury yield is considered risk-free. And so,
You brought up an interesting point that I never thought about, and that
yeah.
is, we do have, this interest rate, let's say it's on the 20-year treasury, but we have the ability to tax and we have a really good system to bring money in. And that maybe is one of the reasons why these countries, like China and Japan invest in the US backed bonds.
Yeah.
I never even thought about that, Andrew. I appreciate it. So
Yeah,
let's
absolutely.
let's let's turn our attention to shipping. And there are 1,000 ships that were stuck in the Strait of Hormuz. Partially reopening does not fix the logistics problem immediately. Insurance costs and risk premiums will remain elevated, and you should expect supply chain disruptions even if oil prices drop. Michelle, what do you think the succession of events are going to be once the bottleneck is opened up?
Even if it is open up fully, which we can't count on in the near term, shipping rates will remain high. Insurance rates, as you said, also will remain high because there's been a backlog of need for the oil and the natural gas, especially in Asia. Farmers needing the fertilizer. There's a type of fertilizer, about 50% of it goes through the Strait of Hormuz. That's really critical. So, and also add on top of that helium, which is used for cooling in the manufacturing of semiconductors. It's going to be a while before all those things start flowing through on a normal basis and the backlog of need kind of unwinds itself. So, what does that mean? Higher prices that are going to be passed on in terms of food, manufacturing, etc. I don't see things coming down for a while.
Yeah, Andrew, I'm not sure if you know this, but which countries ship fertilizers through the Strait of Hormuz? I mean, I only think of the Middle East as a bunch of desert. I don't see them as fields of growing fertilizer.
Yeah, you have a global demand coming throughout the world, and many of which the fertilizers that they're coming from or must pass through the Straits of Hormuz. There are literally over roughly about 700 ships that are waiting, to pass through. Yesterday's news actually have said that a Chinese oil tanker was testing the waters to see if they could pass through, but they were stopped. And so I don't have to follow the minute by minute, play by play of what's going on, but I know that a resolution is near. Every time when there are policies, extreme talks, the most important thing is that they're working at it. I know that there is some tail end risk here that inflation, higher prices, the disruption of free trade, all this is going to be causing inflation and also causing goods to, to not move freely. But there are even talks of, putting in a tow, a $2 million per ship, for example, for Iran to collect, and U.S., jump right on it and say, hey, let's make this a joint venture so that both of us will be able to collect money. Now, I don't know if this is going to open up a can of worms because then the other canal and other passageway is going to, people are like, for instance, Somalia is going to say, okay, you pass through my country, then I'm going to collect the toll too. That's where all the pirates begin. I'm not sure if this is a good thing, but if this is going to reduce the insurance cost of shipping a vessel, ultimately, I think this could work out economically. And so I'm pretty optimistic in this particular case. I believe that, the resolution is near. I don't believe this is going to go on for more than 6 months, for example. And so if you can see Polymarket and Cauchy, their probability of the, situation resolving towards July or the end of June is actually quite high, somewhere around 60%.
So it's interesting because the Strait of Hormuz is international shipping. It's not part of Iran.
Mhm.
So how do they collect a toll in international waters?
Yeah, exactly. Because it's so close to Iran side. The
Yeah.
other side is so shallow that the large ships, they just can't go through it. And that's why the ships are forced to ride and move along the coastline of Iran. And that's why it is so easy for Iran to attack these ships. And unfortunately, that gives them an advantage of controlling the situation. And it is very unfortunate.
So let's take a look at a different subject, and that has to do with mortgage demand. And higher rates plus uncertainty equals a drop in home loan applications. Early signal of consumer pullback, not yet headline news. So Michelle, what do you believe is happening with the mortgages? Are higher rates going to slow down people looking to apply for mortgages?
I think people are very cognizant and of mortgage rates because it affects their monthly payment so much. So when you have a drop of 1% in a mortgage rates, it increases existing home sales by 5 to 10%. That's what I was able to find this morning through AI, and that's a lot. So if you look at the other side of that, if you have an increase of 1%, you could lose 5 to 10% of your home sales. And home sales have a huge impact on our gross domestic product. It's about 16% that there's a follow through or a ripple effect from home sales. It's critical that if you're a home buyer, you want or a seller, because you have a lot of people that have been sitting on the sidelines, not willing to sell their home. So if we could get rates lower, I think you're going to get more movement through the home buyer and seller market, and therefore it'll help the economy, help keep it going.
Yeah, and so far we've been talking all about interest rates in the bond market, and to me that is what happens first. A happens before B and B happens before C. So A is where interest rates are, and then B is where stock prices move in relationship to where A happened, meaning the interest rate move. So when you're looking at trucking and transport and building, what what do you see there, Andrew, in terms of the weekly price adjustments in logistics? Because that goes right to earnings for a lot of logistics companies.
Yeah, they definitely are climbing due to the recent volatility and the geopolitical risk. Fuel oil, gasoline, it's over $4 per gallon for the national average. Diesel sometimes is going up as high as $5 to $6, and that's really uh, adding a lot of weight on the profit margin and the operations costs for the logistics systems. Then you have to add the labor costs, right? You have a one-way direction for labor. It's always going up. I rarely see labor costs coming down voluntarily unless there's a crash or there's some type of a catastrophic event. Those two combination, you see that adding geopolitical risk, it's going to cost a continuation of a higher cost of delivery. Amazon already is adding uh, a fee to the delivery costs for some of the items. For airlines, especially if you're flying economy, they're adding a baggage fee and they're adding $10 to the baggage fee. And so you're seeing across the board businesses are starting to pass through these costs to consumers. But again, the consumer in the US is very resilient. And so I still think even when oil is at $100, the US economy will still survive. I just wrote a piece about it in my weekly notes is that the US economy will prevail because if you look back at history in the last 10 years, there were 2 to 3 periods when oil was over $100. 2022 was the most recent period. Did the GDP go down? No, not at all. It was consistently growing. So the businesses, intermediary, and the U.S. consumers in today's age, we have many choices, and we have the ability and the flexibility to navigate around to deal with this higher for longer oil prices. So, in my opinion, these pass-throughs are still temporary, transitory, however you want to put it. It's the same reason why the Federal Reserve decided to not raise rates, just to deal with the oil spike. Because by the time the effect takes place, most likely the oil situation will be resolved. And so I still look at this as transitory, as a
Yeah.
short term event.
So leadership matters to everything. I mean, when Trump took over as president again, the direction of the country completely shifted. The European Central Bank leadership is under quite a bit of uncertainty, and I wanted to draw Michelle on your knowledge about the ECB and the policy direction changes that might be taking place there.
Christine Lagarde, I think that's how you pronounce her name. Her term ends as the president of that part of the world uh, in 2027. But there's been some speculation, and maybe she's kind of implied it as well, that she may leave her position early because she wants to help Macron, the president of France, as well as the chancellor of Germany, have some transition power as their terms end. So that's kind of concerning to me in terms of stability, because she's always been a very strong person and her leadership, I think, has been very, very good. So if she decides to leave her position earlier with the European Central Bank, I think that could be an issue. And we should be watching that closely because they don't have the growth that we have. And I think interest rates to them are even more important for them to be able to have profitability growth than it is to us.
Excellent point. Andrew, you can
Yeah,
add to that, but at the same time, I
absolutely.
want to talk about how oil trades because people oftentimes don't really understand that oil trades in the futures market and that it sometimes will exaggerate things on the upside and exaggerate things on the downside. So I'd like you to take us through how oil trades, or if you want to add to the ECB discussion.
Yeah, a couple of things that you did mention is that India is looking to cut rates while the European banks ECB is looking to raise rates. Well, the ECB doesn't have dual mandate. They only have to deal with inflation. That's one. And then secondly, they've experienced unusual inflation that really ticked up and also look at where their rates are. So ECB in general, their rates is somewhere around 2.15, meaning they're already at such low levels. And that's why they're even contemplating raising rates. India, on the other hand, what is their rates? Their rates is at 5.25. So that's why it is the natural direction that they're looking to cut rates so that they can stimulate their economy. They also have high unemployment to deal with. Same with Europe. So that's why, when you reach one end of the pendulum, it's the other way to go. So I'm actually grateful for the Fed not cutting so fiercely, in the past and just doing a quarter. And then sometimes you have to understand and agree with that. The pauses are actually good. Now, going to oil, most businesses, if they use a large amount of oil, they have to buy the futures to basically hedge against their cost. And so if you, for example, you go to CNBC, you click on the crude, you see the May 2026 contract. Right now it goes up and down. And yesterday it dropped below 100 and now boop, right back up. Now is at 101 again. And so you can understand that, for example, airlines, they have to use futures and options to protect themselves from their inventory costs so that they can understand that how much to charge an airline ticket, right? They can't just let a component of their costs to be flowing so freely when it's volatile. Same with other businesses, that consumes a large amount of oil. And it really is different, when you trade on, the futures market versus spot. And most Americans, they just look at gasoline prices, which is a refined product, very different from crude because the refinery cost is not there.
So the actual trading of futures, are you comfortable discussing how that works?
Yeah, I mean, mechanically, it is all derivatives, and basically, what is the price that you will pay for a future delivery of goods? So these are the commodities is regulated by the FTC, and it will always calculate in and price in geopolitical risk. Inventories that are measured by the EIA on a monthly basis, and also looking at the demand and again geopolitical risk around there. And so all that is priced in, and that's how the futures trade. And again, businesses, they use it, and also people also trade it for profits as well.
Okay, so finally, Michelle, let's talk about the IMF focus shifting to post conflict economic scars. So, the IMF, can you explain what that is? And when they're starting to shift their attention to the post conflict economic scars, what is meant by that?
The IMF is the International Monetary Fund, and they focus on the economic health of the entire globe. And what they're seeing right now is that there are a lot of parts of the globe that have not recovered from COVID. Hard to believe, right? When we're 6 years out, approximately. And they're seeing areas that don't have the growth that are suffering a lot from not only that, but having famine, etc. And so they're trying to take some of their resources towards the parts of the world that don't have the economic prosperity that we do in the developed parts of the world.
Well put. And Andrew, in conclusion, the IMF is not just about coming in after a war, as Michelle said, but going to places where there is famine and disease. And that's usually Africa, where a lot
Right.
of it is happening. How much attention and how much money should we be putting to the IMF? And are they a respectable group? Or are they skimming money off the top and, as Trump would call it, fraud?
Yeah, it's very difficult to say, but I believe as a first world nation, with the largest GDP in the world, I believe we do have a duty and a responsibility to look after, uh, the rest of the world. It's also the same reason why we took on the role of the world police right here. So we put our nose in to help defend nations that are weaker and not be able to defend themselves. And also, we try to be involved in many of the situation. And obviously, behind the scenes is really about resources and trying to arrange and have a say in the world order. But their main purpose is a humanitarian one. After World War II, I believe they started in the 40s. Try to prevent the kind of economic instability that is attributed to certain events or catastrophic event. And so from post tragedy event morphing away to preventive or proactive measures. I think IMF is doing great work, but who can say that there is no corruption, in between. So hopefully, through the use of AI and technology, we will be able to find these levels or any kind of corruptions uh, by holding people accountable, certain department, accountable, and trace the money and so on and so forth. I believe with the innovation and technology, we will be able to do this job more effectively, just like underwriting and preparing for taxes and things as such. So we can actually put AI to good use. And I think in conclusion, it is our responsible for those who have the resources to take care of those who don't.
Well, what AI can't do and won't do is replace your thoughts, both of you. And I appreciate you doing this very much. So, this is
You'll be
Michelle
surprised.
with Portia Capital Management and Andrew Tang with Turner Financial Group. I encourage all of you watching this to reach out to one of these individuals if you need any help in analyzing your existing portfolios and seeing what these two brilliant minds have as suggestions for you. So, thank you very much to both of you.
Thanks for having me, Ed.
Sure. Bye bye.